You're right. The market is taking this in stride. You know, it's the old Washington saying, make them sad, make them glad. In the last few days, the administration was talking about 100% additional secondary tariffs on India, and they got 25%. And so that, in a way, is lower. I think that that made folks feel a little more comfortable. They think at 25%, India may defy the United States and continue to import Russian oil. And if they continue to import, we don't lose the supply. And if we don't lose the supply, we don't have a price increase. And, you know, this is all occurring as the oil market generally, Joe, I think is starting to transition from this tightness we've been in all summer and spring. And many barrel counters at Rapid Ant included, we expect as we get into the fall, balances will loosen and soften up. OPEC Plus bringing back more barrels, the end of the gasoline season, et cetera. So there's this coincidence, if you will, with this expected softening. And then the secondary sanctions so far being less severe than had been threatened.
Interesting. If, in fact, India chose to follow the president's lead here and stop buying Russian oil, could the U.S. replace it?
Absolutely not. We do not have spare production capacity. That means the ability to sort of crank up millions of barrels a day, even hundreds of thousands of barrels a day in days to weeks to months. We don't. Even if we started drilling and completing all we could as fast as we wanted to, we couldn't do that. Only Saudi Arabia, UAE, some other smaller OPEC plus countries have that spare production capacity. So we can't. The real question would be, can China or other importers to sort of take those Russian barrels? If Russia could no longer export 1.7 million barrels a day to India, would China take up the slack? And if they couldn't, if Russia couldn't find a home for those barrels, they would have to shut in. And then, to your question, the only real offset would be in Saudi Arabia and the UAE.
Really interesting. Bob, we've been watching the rig count drop fairly precipitously since the beginning of spring, as a matter of fact. What does that mean when we talk about drill, baby, drill? Production levels have been at record highs for some time. In fact, it looks like the rig count most recently topped out at the beginning of September 2024. It's been falling in the past couple of months. Are we going to see a slowdown in production the second half of the year?
We will, and I think into next year as well, Joe. It's more chill, baby, chill. It's evident in the rig count data. It's evident when you go to Texas and you go and you talk to the oil drillers, oil producers. We've seen Diamondback Energy speak publicly on this. Look, they've been under this cloud of $50 oil, right? And this mantra of get oil prices lower to beat inflation. Now, President Trump has begun to increase his definition of low oil prices. It's moved to the high 60s now recently. So there may be some relief coming on the margin. But no, this isn't. The shale sector is fearful of this oversupply that I just talked about. They're not the only ones that are looking into next year, seeing oversupplied markets, demand not strong enough, supply still coming, OPEC plus adding barrels, the prospect of lower prices. You know, and as oil prices go lower, shale oil producers are the first line of collateral damage, if you will. They're the ones who begin to restrict activity, and their investors don't want them contributing to that oversupply. So there's caution. They've seen price collapses in 2020, 2015. They haven't forgotten those, so they're very cautious, and that's why we're seeing the pullback. So I think we're looking at sort of flat lower 48 production. Now, we are bringing on some new projects in the Gulf of Mexico. So, and then elsewhere in Latin America, Argentina, Brazil, you're seeing Guyana, more oil. But in the U.S. sort of shale patch, it's more chill, baby, chill, Joe.
I don't know if you came up with chill, baby, chill. That's really good, Bob. But to hear you say the shale sector is fearful is not consistent with the language you're hearing from this administration. Is this what you anticipated? And what does that mean for crude oil? If that drop in production does continue, where are we in terms of prices by the end of the year?
Yeah, well, so just to be clear, the shale sector is thrilled with what President Trump, the
Okay.
NEDC, the Dominance Council is doing in terms of their regulatory agenda, permitting, and so forth. All this is very
Hmm.
positive. And remember, it could have been a lot worse had the other candidate won for them. So I don't want to downplay the happiness of oil producers with this current administration when they look
Okay.
down the road. The problem is, as they look to
Hmm.
the end of this year and to next year, they see oversupplied markets, they see lower oil prices. They hear a president who so far has been saying he's more interested in getting oil prices down to beat inflation and to hurt
Hmm.
Iran and Russia, even if it means pain for the shale sector. So it's more of a near-term type of thing. Joe, we're pretty bearish unless we get a major geopolitical disruption, which isn't our base case. We see oil prices heading well into the 50s later this year and certainly into next year.
Wow.
And that is not going to be a fun prospect for shale producers. I hope we're wrong.
Wow, fascinating. And what that will mean for production could be really important. Lastly, Bob McNally, we've got the tariff deadline kicking in tomorrow. Kind of amazing how many deadlines we're talking about, not to confuse that with secondary sanctions against Russia. These would be the reciprocal tariffs that the president detailed at the end of last week. Does that do anything for oil or gas prices from your view?
It does. It puts them under more downward pressure. Until recently, the macro data, the jobs data, the financial market data was
Hmm.
pretty supportive. There was a sense we had dodged a bullet after those Liberation Day tariffs and the swoon that you saw in financial markets and sentiment, really.
Yeah.
We sort of recovered and gathered ourselves and collected ourselves in the summer. But now, with that payroll downgrade, with concerns about these tariffs now going into effect. I mean, 10 to 15% isn't 50%, but it's not nothing. We're still at post Smoot-Hawley highs. And so I think barrel counters, as we look into this later this year into next year, and you start to factor in this returning supply against this more fragile economic outlook, it's sort of exacerbating those concerns, those clouds that had been on the horizon about oversupply, too much oil, and downward prices. Final thing, let me say, though, if President Trump is going to put Russia and Iran under pressure on oil, that could be just what the doctor ordered. In other words, it could prevent next year a price collapse that would hurt the shale sector. So there may be a silver lining
How about that?
on this cloud for President Trump anyway.